So we are going to start the first session of today, and we're going to be talking about international finance aspects of climate risks. We have 3 papers. Each presenter is going to have about 20 minutes, and the discussants have 10, and then we have another 10 for Q&A with ample time for more questions if needed. So the first presentation of today is going to be given by Daniel Kapp. He's going to talk about transition versus physical climate risk pricing in European financial markets, a tax-based approach. Daniel, the floor is yours.
Thanks a lot. Climate change is real, by the way. I walked here in a suit. Very, very impressive already at 8 in the morning. But all right, let me start. Transition versus physical risk pricing. This is joint work with Giovanna, who's at the ECB as I am, Federico Ramella, and Lavinia Rognone, who is at the University of Manchester at the moment. Needless to say, short disclaimer, everything I say is not necessarily representative of the views of the ECB, and all errors and omissions are my own or ours. And with that, I jump in. Now, supposedly, climate risks are increasingly reflected in asset prices, in firms' valuations, and there is a very, very quickly growing literature that tries to document this. And it doesn't seem as obvious to document this phenomenon as it is to state it. So the results in the literature are very much mixed. Balkan and Kashpacic have a nice review on that, and I'll get into more detail on that. So what we are trying to do is we try to look at the challenges for these conflicting results, or challenges to come up with clear results in this literature, and identify 3 and then try to alleviate some of this. And one challenge we see is that there's a lack of standardized climate risk exposure metrics. So exposure metrics in the sense of ESG ratings, as you of course well know, don't correlate extremely well across providers. Different investors look at different things and so on. So there may be a failure to detect exposures, to detect climate risk. And that is something we try to shed light on, in the sense of what do investors actually use, what may they use in order to identify different risk types, so physical or transition risk. Then climate risks are very multifaceted. So that's why a lot of the literature actually looks at one risk type. So for example, transition risk, regulation, or droughts, or something very specific, because you have a problem identifying these risks, and the risks are very different from each other. And then there's, of course, a third option that we then also try to look at, which is financial markets simply may not care, right? So then you don't find any climate risk premia by definition. Now, what we do is that we distinguish between physical and transition risk. So we construct 2 risk indicators, and we do so based on text analysis. We build on Engel et al. 2020, and that was kind of a seminal paper in the field. What they do is that they construct a text-based risk indicator for climate risk. Now, for climate risk as such, what we do is we go one step further, and we try to distinguish really between physical and transition risk by using this text analysis, and then investigate the metrics which investors may use, as I said. What we find, and then I'll get to it, emergence of a physical and transition risk premium since 2015, roughly. Firm-level information. Firm-level information means ESG ratings, GHG data, seems to be used by investors to gauge transition risk. However, it's not a good proxy, and intuitively that makes sense for physical risk exposure. And in contrast, investors may do something that's been suggested a long time in the literature, namely they may simply pigeonhole firms into sectors, which allows them to gauge a little bit the exposure to physical risk. Now, how do we do this? First, a few words on the literature at least. Physical risk literature is still limited. And as I said, mainly focuses on very, very specific risk types. So we have Hong et al. They look at droughts and they look at food companies' returns and how they react to this. Then we have Adam et al. They look at high temperature events, impact on productivity, on earnings, this kind of stuff. So you see, it's very, very focused. The literature on transition risks is much bigger, and arguably transition risks for many firms matter more than physical risks. And there, seminal studies are Bolton and Kasperczyk. They also provide a nice overview. We have Ardia et al., Pastor et al., and they generally find, if they find anything, that green assets have a higher return when they are surprised by climate risk shocks, so when climate risk shocks appear. However, that's not the case for the full literature. So there are studies that find exactly the opposite, find nothing, and so on. So what we do is, first step, we expand on Engel, and we look at a large body of scientific texts. Scientific texts, so that's really our first step. Scientific texts in the sense of IPCC report. There's a very big study from McKinsey. There's another one from a regulator. There's a nice one from the IMF. And we try to identify which texts or which part of these very, very large document, 24 in total, talk about transition and which one talk about physical risk as a topic. And from this, we build vocabularies. And the nice thing is that by creating unigrams, bigrams from this, so we go through, let's say, the Engel methodology, but on these two things separately, we construct two vocabularies that are really different in nature. We rank them by term frequency scores, so we try to see where is a text and specific terms really important in one text, but not in the others, right? And we then rank these words, we build a vocabulary. So I don't go into detail, but in the end, we have two different vocabularies that I show you in the end, the result I show you in the end, right? With terms and with unigrams, bigrams, and so on. What we then do is we look at daily Reuters news. So that's a lot of news from Factiva. We source this. And in the end, the approach is called a cosine similarity approach. What we do is we try to see on a given day, has news, and specifically the first news on a certain topic, has news been relatively similar in coverage to the vocabulary that we have defined as transition or physical risk vocabulary. Now, why do we think this makes sense instead of just looking at defining a few words and say, let's look for transition risk, let's look for physical risk, let's look for drought, let's look for higher carbon taxes or prices by ourselves? Well, by looking at these large texts and really trying to be relatively scientific, we don't have a selection bias. We don't choose the terms ourselves, and I think that's something nice, and that's really opposed to what most of the studies do. Second thing is that I think we have a relatively complete and large set of climate risk information that I at least couldn't have come up myself without having these scientific texts in there. And we have relevance-ranked vocabularies, right? The more often a term is mentioned in these texts that we group as physical or transition risk texts, the more important this term gets. Now, on the left, you look at a representation of the physical risk vocabulary as it is in, and those are just the most important terms. And you see that you have a lot of words that are really specific to physical risk: precipitation, glaciers, permafrost melting, sea level rise, coastal regions, extreme events, and so on and so on. And some of these terms, of course, they can be expected to come up in the text and in the news on transition risk as well, right? What we see, however, is that these two vocabularies, they actually don't correlate highly. So you cannot explain much of the physical risk vocabulary with the transition risk vocabulary and vice versa. So they seem very different in nature. And specifically, for example, GHG emissions is in both vocabularies naturally, but gets a very different weight, right? From this cosine, From this cosine similarity approach, what we get is a concern index, we call it. And this is what you see on the right. Concern in the sense of on each day, you see how similar have the news been compared to the dictionary. And I don't think you can see it very nicely. I apologize for this. On my computer, this looked very clear. But in the physical risk vocabulary, you just have to take my word or look at the paper. What we get are mainly, and especially then, we run an AR1 and identify daily shocks. On specific days, the highest risk shocks are physical risk events. So we have the Arctic, when this big, you may remember it, this big glacier broke off. We have what else do we have? We have the physical risk in the US, we have hurricanes and so on. And you see that many of these highest risk shocks, they are actually in the recent period. Now in the study, we only go to October 21, but I've updated the index here to most recent, so you see it. And many of these risk shocks are really in the most recent period. Now, this thing doesn't have much of a trend because, I mean, these are daily similarities to the news. So in the end, what we want is a daily shock, right? Not a constantly trending indicator. I show you the same thing for transition risk, and you see the words are different. That's one thing. GHG becomes very big. Then we have a lot of technical terms, technical potential, technical innovations that are forced with subsidies in there, and we have CO2 prices. I don't see them right now, but all of this is very high ranked in the vocabulary, and the terms or the dates where we have the highest risk shocks, they are mainly regulatory events. So here we have IPCC discussions by politicians, we have the Paris Agreement, we have EU climate target discussions and this kind of stuff. Yeah? All right, now armed with this arsenal, we go to the next step and we say, what we ultimately want to do is we want to see if we can find physical or transition climate risk premia, right? And the standard way to do this here, I would say we're not super innovative. We build portfolios. So we use a portfolio sorting approach. And the first thing we do is that we look at time series regressions of equity returns, right? That you have on the left side, excess returns actually, on climate risk indices. So that's the beta TRI transition risk index. Yeah? And we control for pharma fringe factors. Good. From this, what we are interested in is the beta. Right? So the beta tells us what? The beta tells us the loading on the climate risk factors, right? Now, if this beta is very positive, that means that in the face of a climate risk shock, these stocks outperform. So they are good climate hedges. If they are good climate hedges, in the finance literature, investors should be willing to accept a lower expected return upfront, right? And vice versa. So we use these betas. This is a rolling regression, 3-month daily data, and we classify the stocks into these portfolios. And then we build a low minus high portfolio with different types of these quantiles, deciles, quintiles, and so on. And we try to see if we can actually find climate risk premia. The second thing then is that we this was still the portfolio building approach. Now here, we try to see if we find climate risk premia, namely having these portfolios. What we do is we again run a regression where we control for the pharma fringe factors, and basically what by portfolio, right, what we're interested in is the alpha, and the alpha is then your climate risk premium, okay? So far so good. So we estimate one regression, we're interested in the beta, we use this to build portfolios. Run a second one, interested in the alpha, see if there is a difference in the alpha between portfolios or in the high minus low or low minus high portfolio, see what we get. And first thing I want to show you is really just the excess return of these portfolios. So this is the excess return of the low minus high portfolio. Very dark are quintiles, so the portfolio is built on quintiles, and then deciles and percentiles as it gets lighter. And one thing you see, and that many have documented in the literature by now, 2015 seems to be a game changer. So really with the Paris Agreement and in the month thereafter, we see that climate risk, or that excess returns of stocks that are a relatively good climate hedge start to appear, right? And this we see for transition risk. We also see it for physical risk, a little less clear, but we see the same thing. Now, let's look at excess returns. And here again, I'm so sorry, I don't know why this doesn't show up very sharp, but ignore the table and just look at my results and trust me that I've interpreted the table rightly. What we find is climate risk premia since 2015, larger premia for very extreme portfolios. So if you go into the very small and extreme portfolios, you find a larger outperformance or underperformance than if you, what many in the literature have also done, not just divide the market into two portfolios or so. Now, what do we do with this information? And really, the one thing we want to see is, do we find, by the way, yeah, this is the same for transition and physical risk. So these risks, they seem to appear, right? These outperformances seem to appear. But what we are interested in is really why. What do investors potentially look at, and how do they make up their mind what a good climate hedge may be and what a bad climate hedge may be? And therefore, what we do is, in the second part of the paper, instead of building portfolios according to the betas I've shown you, so according to the exposure to climate risk, we build portfolios by ESG factors, by E scores, by GHG factors, or by GHG levels, I should say, and by GHG relative to revenue, so scaled by revenue. And the intuition is that investors may look at E or ESG scores, greenhouse gas emissions, in order to gauge how sensitive a company is, in particular to transition risk, right? I mean, that would make a lot of sense. And we weren't sure if we'd find the same for physical risk, because ESG scores, all of that, are not exactly built to represent physical risk, right? So a second thing we do in this second part of the paper is that we say, well, investors may just look at specific sectors and then pigeonhole companies into these sectors in order to gauge exposure to transition risk. So, to physical risk. And now, this is, yeah, I get to the results in a second, but just to give you an idea where that may be the case, well, for example, telecommunications, right? You have big infrastructure that may be hit by a hurricane there and then needs to recover. Mining is a candidate where the literature finds a large exposure to physical risk, and so on. So, how do we do this? We aggregate the returns into green and brown portfolio, and we run again the same type of regressions, right? So we regress excess returns on our transition risk and physical risk indices, or the shocks, and control for pharma French. Now, again, you can see absolutely nothing on the left, I assume, but on the right you see the key messages, namely, we do find that firm-level information is used as a gauge for transition risk exposure. Consistently so as of 2015, before not so much. We find a much clearer picture for ESG ratings than for GHG emissions. Now, in terms of pricing, what we see that this is true for green portfolios. We don't find much evidence of negative performance here or negative pricing for brown performance, brown companies, if we classify them as E or ESG portfolios. Now, sectoral classifications are not useful to gauge transition risk exposures. This is nothing they look at. And by the way, if you see how these E and ESG metrics are constructed, then that makes a lot of sense, because you have within the sector usually a reweighting, right? So you have an industrial company, a car producer, who is compared to another car producer and not necessarily to an IT company, right? And this kind of reweighting makes a big difference for transition risk impact, and it just simply doesn't do much for physical risk. Instead, what we find is that sectoral information may be used to gauge exposure to physical risk. And there we are really in line with Adi et al., I believe, and others, who find that overall, if you look at things, transition risk is the main driver. And if you look at physical risk, then really sector classification matters a lot, less the traditional metrics. All right, so what have we done? I wrap up in 1 minute. And that is, we have two novel vocabularies. They separate physical and transition risk. And these risk shocks, concern indices we build, they have a wide range of applications. We're happy to share these. We've shared these with many already, and I'm happy to see them used, obviously. What we take away from them is financial markets do price physical and transition risk, but they price it using different methods and different tools, right? The next things we are looking at are different asset classes, potentially also different ways to construct risk indices from text analysis. But for now, corporate bond markets are really our focus, as we as the ECB are also very much invested in that market. I leave it here. Should I move over? Come on.
Our first discussion for today is Harrison Hong.
Are you going to do that for me? Does that work? Yeah. All right, great. Thanks a lot. Well, thanks for having me in this session. So this is Daniel and his co-authors have written a really interesting paper on this distinction between transition and physical climate risk. Let me just give kind of a quick summary. So what are the main findings? The authors build sort of some notion of a library that distinguishes between physical risk. Typically, this would be disasters and whatnot, and transition risk. So that would be like regulations. They use a variety of text mining techniques using European Reuters news stories from 2005 to 2021. So this is definitely about Europe to pick up basically stories about sort of the PR, physical risk, and TR, which is transition risk. And they create sort of this index based on sort of abnormal amounts of news related to these topics. And then I mean, they do a bunch of different empirical asset pricing stuff, but I'll focus on the main thing, which is they run rolling daily betas of, I think, the Eurostat 600 companies, daily returns on these PR and TR indices. And then kind of the baseline findings are that they sort on these betas, and they find that the portfolio of high betas kind of have higher returns if you have more exposure to these risks. And you know, I think this is a pretty interesting set of exercises. There's a lot in the paper, and I enjoyed reading it. I think the exercises are predominantly, I would say, motivated by the sort of investor hedging approach. So it's something like along the lines of a CAPM, ICAPM, where you know you're going to have this additional climate risk factor. But they're going to kind of treat these two risk factors differently: this physical risk factor and this transition risk factor. But you know, once you think of it, these things as sort of exogenous, and it's really the hedging demand that's a driver of the expected returns in these asset prices. Okay. You know, I think I'm going to keep my comments fairly broad level. I mean, I think the paper is a really good paper. I think there's actually a lot one could do with the paper. So most of my comments are along the lines of, you know, I would call it like my own pet peeves or my own philosophical things about this. You know, is this sort of traditional hedging approach, which I think we've all inherited from thinking about neoclassical asset pricing, is this really the right one to think about climate risk? So I'll kind of talk about that. And then I'm going to propose sort of what I view as kind of an alternative approach to the data that I think really links much more in kind of an optimal planner scheme, the nature of taxes and regulations to fund real mitigation of physical risk, right? That is, you know, what I view the problem is that, you know, no one would particularly care about climate change if it was not bad for the world, right? I mean, for a while, I mean, there were a lot of climate studies that suggested like high temperatures might be fairly good for agriculture, for instance, right? This is the very early Nordhaus stuff. But of course, I think data has revealed that, you know, higher global temperatures has a bunch of deleterious effects, you know, predominantly through a lot of disasters. And as a result, the way that we should think about transition, you know, this notion of a transition risk, I find kind of an awkward language because ultimately, transition means regulation, and, the planner is only going to do regulation that helps improve social welfare, right? And presumably the counterfactual, it also improves the company's performance as well, okay? And so I want to kind of push back a little bit on this sort of more exogenous distinction. And then I think kind of in this approach, I'll kind of raise different questions and tests I think that the data might shed light on. Okay. All right. So, why am I skeptical a little bit about this sort of hedging view? I mean, I think kind of the papers that Daniel alluded to, I think probably paint maybe too optimistic a picture about the efficient functioning of these markets per se in terms of the ability to hedge out these sorts of risk. So first question is, can we accurately predict actually which companies will be more affected by disasters? It's not so obvious, right? So, I think, I don't know the entire climate literature. I know some of the climate literature pretty well. For instance, if I think about tropical cyclones, right? There's a huge amount of work done on the impact of global warming on tropical cyclones, which is obviously a major physical risk. I mean, this is by far the #1 physical disaster for, I think, 30% of the global population, and much of this population is fairly vulnerable, okay? But it's almost impossible, right, given kind of even the leading climate models, for any of them to predict at a very granular level. So meaning like there are predictions that says that we will have more intense cyclones at a global level, but if you were to drill down onto like, will the Philippines actually get more tropical cyclones, or will Europe actually get more heat waves? The climate models just go crazy, right? They can't really do that, right? So there's a huge amount of uncertainty. So I think this notion that we can measure kind of a physical risk beta, right, which is really now drilling down to the level of where firms are producing stuff, right, where the firms' plants are in Europe and what the impact of this would be, I think it's a tough one. It's not that it's not doable. I mean, for sure, I think many people try to do it. So for instance, I sort of have in another role, I'm an investment advisor for LSV Management. So they manage about $150 billion. And we deal a lot with these issues, and we get a lot of the reports about these sorts of physical risk. But if you actually drill down and look at what's happening with the names of companies, right, it's very difficult to sort of, I mean, there are names, but it's very difficult to really kind of convince yourself that you're going to put any significant amount of money using this type of information. And I think anecdotally, if you look at the evidence on investor portfolios, most of the stuff that's happening in the investor portfolios right now is just really driven by these net zero green mandates, which are fairly, I think, pledges or I don't think people are using very sensitive betas that think about how to do these types of mandates. They're fairly, let's rank companies and just dump the worst ones that have like, the worst carbon emissions. And I think even if you look at, for instance, the surveys, I think the survey that's often cited is this Kruger-Starks and Zoutner survey, which was in this climate finance special issue that I had edited. I think most managers are not so sensitive at this point, at least in the developed markets, right, to this notion of like a physical versus a transition risk beta. So I think kind of, that's not to say that the findings could not be super useful. I think that, one way, I mean, it is kind of, you want to sell the paper that way, it would be very helpful to unpack what exactly are the names of companies that are being exposed, right? And compare these, for instance, to the MSCI names, right? And do you really believe that there's these betas that you're capturing are really going to be persistent, that you can really put serious amounts of money on particular names and drill down on the names? I know, for instance, we've looked at some of these names for the LSV portfolio, and it was very hard to kind of convince ourselves to kind of put big bets on these kind of betas. Okay. And I think kind of the second notion I would draw is that, is transition risk really distinct from physical risk? Back to the earlier comment that I made, right? That regulation obviously is much more likely when the world realizes that there's much more damages associated with global warming, vis-a-vis disasters and whatnot. Okay. So I'm going to kind of give an approach. This is sort of based on some joint work that sort of, being revised for, right now with Nyholm, who's my colleague at Columbia Business School, and Jin Changyang based in China. So here's the way I think about this notion of transition risk and physical risk, which is, you know, first, I think you need to start with a model of production. I don't think kind of a consumption type endowment model of hedging is very useful for thinking about climate issues, but predominantly. So, you know, you start with the Tobin's Q model of some notion of how you would deal with disasters that might come as a result from global warming. So I will take that physical news is exogenous. There's going to be some news about whether or not global warming will be really bad, right, in terms of these disasters and whatnot. And of course, we're all going to be learning, and I think that's exactly kind of what we're seeing in the world right now, is we're all learning about basically when these disasters start arriving, right, with heat waves in the summer, we're like, oh, yeah, that looks kind of real. I guess it's bad, okay? And that's what's going to be driving then the mitigation responses. In other words, like the underlying state variable is really beliefs, right? Beliefs about the consequences of quote-unquote physical news. And then that's going to, of course, lead to all types of responses like taxes, regulations, seawalls. That's what's being picked up, I think, in this kind of regulation. And for sure, I think Europe is like at the leading vanguard of this, much more so than the US, right? I mean, Europe has just been miles and miles ahead in terms of many of these issues. So, and so then the way I would think about it is mitigation actually, when you see this regulation, is not like sort of a bad thing per se, right? The counterfactual is that if you didn't have it, right, if the government wasn't funding this, these companies would end up in the very long run potentially suffering from these physical risks, right? So hence, I think kind of the overall impact on firm prices is really kind of this has to be thought of in this more kind of mitigation, real mitigation way, as opposed to sort of this exogenous kind of distinction between bad news and you know, physical and transition risk. And I'll kind of stop there. But I think that would be kind of my general comment is that, you know, given these news indices, one could do quite a lot to try to think about basically the relationship between regulation, right, and these physical news. And then basically use that to think about the disciplining of how you would think about the response of asset prices when you have these multiple mitigation factors. All right, thanks.
The Fama Friends factors probably price risk. And so they might be a bad control here in the sense of if they capture business cycle risks, then it could be that part of the way in which the climate risk is actually reflected on different assets is through their betas on the Fama French factors, in which case they'd be a bad control. So I guess that's not exactly a question, but is there a way, like what does it mean to think about these risks conditional on the Fama French factors in a world where those are the three primary financial risks, and if climate risk is existential for some of these businesses in the long run, then you'd only be capturing a pretty small fraction of maybe what was the most economically important risks.
Okay, I have a question too. So I don't know if you know the paper the team at the Frankfurt School of Management put together, Sonner and company, where they scrape the corporate calls. I think it would be interesting. Those are available with ISIN numbers, so I imagine you can merge them to your data. And I think it would be interesting to see if their measure of climate risk, which is based on how frequently the word climate risk is mentioned, whether it correlates with your measure of physical risk or with your beta on physical or transition risk. I think that would be very useful information for those of us trying to work on those topics to see what it actually proxies for.
Galina, can you move the microphone, please?
Yeah. Can you raise your hands again? Because
I was just wondering how your paper relates to the work by Seth Broid and co-authors on the cost of ESG investing, and I guess they find that there is no cost. So is this a matter of robustness if you use more factors, or what do you think of that?
when we're talking about physical and transition risks, there is not much on the narrative of physical and transition impact or double materiality. And you looked at the time series from 15 to 21. I mean, in 15, the literature was very different, and it evolved very fast. So in a sense, when you look at the kind of word cloud, do you see an evolution? Are they talking about double materiality? Are they talking about impact? What are they talking about in terms of ESG risks, etc.?
Daniel.
Well, I start with you. Thanks a lot for that discussion. Actually, very inspiring because I agree with you. I think we all doubt, in how far you can really expect a certain company to be hit, especially by physical risk, right? So from all of what we do, I think the biggest doubt still lies with physical risk, even though, we're the first ones to try to unpack this. The nice thing is that I think you get at least shocks here, which really do occur at moments of physical risk coming up. Then really predicting which company will be hit, which not, is this the right approach? Everything you said, I think that's spot on. And I think unpacking this to a company level, that we will try to do and see, this I've never looked at it, to be honest. Do the very high betas on an individual company level, does that make sense? Not. So those are, thanks, those are great ideas, which we'll try. On the other questions, pharma French factors, are they a good control? That's a good question. I have no idea, because what you're hypothesizing is that these really do correlate with evolutions in climate risk, right? And I don't know. I have never looked at this. On first instance, I don't think so. I wouldn't expect them to massively, maybe in a very slow-moving way, yes, a company that's persistently hit by some kind of climate risk, by some kind of regulation, certainly this will be reflected in the pharma French factors. In the kind of regressions we do here, I doubt it. And if anything, then we underestimate the risk. So fair enough, but I don't know. Frankfurt School of Finance, Google search. Yes, great. I've done it myself last week, so I ran a few Google searches just to see how our indices compare, and word counts for climate risk, transition risk, carbon taxes, all of that. And the problem with these kind of searches I have is that if you look for one word only, so if you look for climate change, for example, or climate risk, right, you get a very much monotonously increasing news coverage over the last 1, 2, 3 years. You get a lot of persistent news coverage today. What I don't really get so much are the risk shocks that I'm after here in our vocabulary, and I just can't make that distinction, right? So they don't correlate highly with what we do. I've never checked really with the data. I'll try to get it. But on first intuition, I would say they try to gauge something very different from what we try to do, which is really similarity to scientific texts discussed in the IPCC reports, in scientific reports, and so on. So it's a different way of thinking of it. No, it's general news coverage, general discussion of a certain topic versus specific events, really. No, I guess that's how I would put it. Evolution of vocabulary, double materiality, and so on. Yes, you're right. So that topic and the regulation with it, right, it evolves very, very quickly. And therefore, I would even say the E and ESG ratings 7 years ago, they were very different from how they are today. Does our vocabulary catch that? I don't know, and if you just, and then I close, if you just bring up my risk indices, can we still do that? Then I just want to point out one thing, and that is that I think the coverage of that topic has changed over the last years, which we may not perfectly capture, because all of the texts are from the last years, right? So they may not be very, very representative of the news in 2015. That's a problem we may have. But I also think here, go back to 7. Or 5, yeah, this one. Here, what you see is that really, over the last years, what's changed a lot is on a daily frequency, so this gray area, how similar or very dissimilar on a given day the news is to our vocabulary. So we're trying to look into this. I can't fully put my foot on it. But I think the coverage has changed, and you see it. It's right around COVID, which may also have something to do with it. But you have days where there's a lot of coverage on the topic and very specific, very, let's say, up to scientific standards. And on the next day, it's the complete opposite. And the topic is discussed differently or not discussed. Maybe it's something COVID that then picks up. I don't know. But this kind of, you're right, vocabulary may change and coverage may also change over time, which then we don't capture perfectly, right? So, yeah.
Okay. So yes, this is joint work with Margherita Giuzio, Sujit Kapadia, Johannes Krämer, Nyholm, and Katia Vozian at the ECB, and then Johannes Krämer at the IMF. Usual disclaimer as early, the views that we present are only ours and not necessarily reflecting those of our affiliated institutions. So the motivation underlying this work, we have briefly touched upon it also in the earlier presentation, is that transition risk, by which we imply the uncertainty concerning the pace of government policy tackling climate change, the technological change that may affect the kind of technology used in firm production, and the transition to the greener economy, as well as the market sentiment that is related to this uncertainty, all have the potential to impact the firm's credit risk via various channels. We can think about the hit in revenues that result from higher carbon taxes, as well as the problematic with stranded assets that, due to stricter policy, may be unusable in the production in the future. And from this transmission channel related to transition risk and its uncertainty, moving to the credit, establishing this relation with credit risk, then we can also draw these conclusions that are relevant from financial stability, we think, given the exposure of banks and other financial institutions to the particular non-financial corporations and the capability of repaying the debt in event of default. And if we go to the research question that relates to this transmission channel that we just described, we are trying to establish to whether and to what extent climate-related transition risk is reflected in firm credit risk. We operationalize this overarching research question by looking specifically at three hypotheses that we can then test throughout our empirical framework. So whether the direct metrics that proxy for the direct exposure of firm to transition risk are indeed associated to two different variables capturing credit risk. And we do find that this is indeed the case. And government policy, so depending on the jurisdiction where the firms operate, plays an important role in moderating this relationship. Then we look whether proactive actions from the firm side, as well as forward-looking commitments, do play a significant role in moderating transition and credit risk. And we do find that the act of disclosing emissions is indeed a factor that moderates this relationship. And on the other side, the ambitiousness and the act of being aware of this of the transition and having policies in place to manage it is something that is priced in the metrics of credit risk that we use. Yes, this paper fits in a really vastly expanding, I would say, literature that addresses in particular credit and transition risk. As we've said, there are also like a broader kind of analysis looking either at the equity market, but we focus here trying to summarize the papers that are most related to our work. And this is not an exhaustive list, because I was just recently seeing work by authors in the US, addressing like a bond-specific measure of credit risk and transition risk, so something really close to what we are doing. But what we are trying to contribute with this analysis is moving a bit beyond from the backward-looking metrics of transition risk that have been used so far, so either e-scores, firms' emissions, and including this forward-looking aspect, which we find and deem to be really significant in establishing this relationship. Then having a framework that allows to analyze both credit rating agencies' assessment of credit risk and the market implied measure coming from the distance to default, so to get an understanding of how these two speak to each other and what might be the differences in the pricing mechanism that occur in these sectors. And then I said like a focus on the government climate policy by looking at firms located in European and the US jurisdictions. In order to do so, we construct this data set, merging together a wealth of sources which are needed in order to bring together the basic financials information we need in our analysis, together with specialized climate data providers that really are good at capturing metrics of transition risk and then inferring those metrics when they are not self-disclosed by the firm. The population of interest here is the NFCs of the S&P 500 and the Stocks 600 indices. We collect data between 2010 and 2019, and at the bottom of the slide you see summarized like the schematic view of the theoretical mechanism that we have in mind to estimate this relationship. So our two dependent variables are going to be either the credit rating as provided by S&P or Moody's, or the market implied distance to default computed through the Merton model. And then we are going to have as our regressors what I was saying, the backward-looking greenhouse gas emission levels and emission intensities, a dummy indicating whether the firm self-discloses or not one of the three scopes of GHG emissions, and then how the firm is supposed to manage its exposure to transition risk. So forward-looking targets, commitment to reduce their emissions, and also looking at the past performance in the firm of actually cutting its emissions year on year. And then we have a set of controls which we take from the standard credit risk literature, factors such as leverage, solvency, that are common for both our dependent variables and then some macro variables that we use only for the distance to default part of the analysis. So, yes, I was not sure like how much I should go in detail of the definition of the transition risk metrics per se that we use, given that now in the literature there seems to be a growing consensus on what these quantitative metrics are. But in any case, we look separately at scope 1, 2, and 3 emission intensity and emissions levels, be them estimated or self-reported by the firm. Then we have this dummy on whether the firm self-discloses or not their emission, the change that we observe year on year. And then if we move on the forward-looking side, we are interested really in these quantitative targets, which unfortunately are available only from 2015 upwards, but the dummy indicating whether a firm is disclosing a target to cut its emission, that one is well populated throughout the whole data set, the length of the panel that we are using. And to give you some stylized facts about the data set and the set of firms that we include in our work, we see some comforting evidence in the sense that the share of firms that have been disclosing their emission seems to have gone up throughout the years that we have in the panel. We know that like high emitters being the one most subject to scrutiny are the one disclosing the most. There is a kind of similar trend when it comes to forward-looking reduction targets in emission, even though here the shares are lower. And then in the shaded area, you can see the percentage of these disclosing firms that are also having an external auditor for their environmental reporting. Now we move to the first part of our empirical analysis, and here I should say that we are really trying to find evidence of a causal relationship between the exposure to transition risk and credit ratings. This starts from some panel regressions that we run earlier seeing like just whether both the metrics of credit risk do reflect to some extent the raw exposure matrix of transition risk, so the emission intensities, and we do find that in line with the literature, this seems indeed to be the case, even though when we split the sample between European and US firms, we see that it's the European firms that are driving this significance of the result. That's why when we think of the Paris Agreement as the exogenous shock that might be driving this relationship that we want to assess, and that's why we have the first diff in diff setup, where we define the treatment in these three different ways. So we take the firms in top polluting industries as defined by the CO2 and methane emissions, group them by NACE code, and take the firms that belong to the top ones of the series of NACE codes sectors that we have in our sample. And then we take also the top quartile of firms in terms both of the distribution of intensities, scope 1 intensities and scope 1 levels. And we interact it with the post-Paris dummy because we think of it as the exogenous event we are interested in. And then the addition I was mentioning earlier is to see whether the differential expectation about the climate policy play a role, and we do it by having this triple difference in differences approach, adding one more term for the firms that are domiciled and conducting their operations in European countries, which we know have where the policy environment when it comes to climate policy has been different even post the Paris Agreement. Here clearly we wanted to see whether the parallel trends assumption was holding before running these diff in diff specifications. We see that for two of our treatment groups, post-event dynamics seem to differ markedly from the dynamics of the control group. Here, the average ratings of the treatment control group are standardized to 100 in 2014, prior to the event. And even though we see a bit of pre-trend dynamics when it comes to the firms in the top polluting industries, we still think that what we find in terms of these post-event dynamics are something significant and may indicative of this causal relationship that we are estimating. And here is the result of the first diff in diff approach. We see that on average, after the Paris Agreement, European firms active in the most polluting NACE sectors, so worsening in their credit ratings of about half a notch, and similarly, the firms in the top quartile of the greenhouse gas level distribution, so worsening about 0.4 of a credit notch. So this seems to be both econometrically and from an economic perspective some significant results that we do find. When we then move to the triple interacted term, we see that actually what is going on in our sample is that the European firms are the ones that have the strongest significant impact, while for US firms, this seems not to be the case. We even find that for some treatment groups, the rating actually increased prior to the event. And this might be evidence of the fact that how climate policy changed markedly in the US with the election of Trump and then the withdrawal of the US from the Paris Agreement, and probably indicating that credit rating agencies do indeed differ in their assessment of transition risk, particularly conditioning on the policy of the jurisdiction where the firms operate. Yes, then we move to the second set of results, which are on the forward-looking and climate risk management aspect of our paper. And we run these regressions both with credit ratings and distance to default, using ordered logic when it comes to ratings and OLS when it comes to distance to default, given the different nature of the variable. And we find that together with holding this negative significance whereby higher intensity or emission levels relate to higher credit risk, the act of disclosing is something that really moderates this relationship, and the firm seem to have a higher, lower credit risk by engaging in this act. If we go to the forward-looking targets, here we just use the dummy, and we see that the effect is similar. So firms that actively disclose having a target to reduce their emissions also enjoy better credit ratings and higher distance to default. And then, yes, we also try to use some quantitative ambitiousness metrics, so the percentage of emissions to be cut and the year by which the target should be met. And the data set shrinks a bit, but there seems to be, at least for credit ratings, some evidence that the more ambitious targets are also reflected in lower credit risk. Yes, we have also some kind of visualization of the economic significance of this relationship, and we see that the two bars in yellow, which are just the effect coming from the dummy of disclosing emission or disclosing the forward-looking target, is of economic significance that is close to what a standard deviation change in leverage, which is one of the traditional determinants of credit risk, has on the rating of the firm. Yes, to wrap up, before we go to some policy conclusions, we did find that it is true that high emissions are associated to some extent with higher credit risk, both when we look at ratings and the distance to default. The government transition policy and climate policy affect significantly how this relationship looks like. That's what we saw for credit ratings in particular. Disclosing emission moderates the negative relationship between emission intensity and levels and then the credit ratings and distance to default. And similarly, the more ambitious and the more aware of the strategy needed to meet the changing policy environment through the forward-looking targets the firm are, is also something that reduces credit risk. And all of this is subject to the usual caveats about the data quality that it's typical of the greenhouse gas data and all kind of the transition metrics that we used in this analysis. And yeah, I don't know how much I have left, but I could stay here. Yeah.
So our discussant for the paper is Nora Pankratz.
Would you mind if I stand up?
No.
Maybe I'll just do that.
Yes.
Walk around here, that's okay.
Yeah, you need the microphone.
Oh, do you think so?
Yeah, we.
Oh, okay. Yeah, maybe then I'll just sit down and do that. Okay, see if this works. Nice. Okay. First of all, thanks a lot to Galina and Fernanda both for inviting me, and Sante for the really nice presentation. Really enjoyed reading this paper. So this is on transition risk, but with a specific focus on credit risk. And before I jump into it, I still have to say, so I'm at the Federal Reserve, so that means all of the views are strictly mine, not those of my employer. All right, so let me quickly recap what's going on in this paper, because there are a lot of things going on in this paper, really, which I think is both a really good thing, but also can be tricky in presenting all of this. So first of all, we look at the relation between carbon emissions, and there we have 4 different dimensions in the paper, so levels, intensity, disclosure, and targets. And the relation of carbon emissions with credit risk, where again, we have 2 different dimensions. So we have credit ratings and distance to default. That means, in a way, if you read the paper right now, today, as it is online, you see kind of this matrix of different estimates in there, and it can be quite a challenge to just really see at the first glance of all the things that are going on there. So I tried to break this up in 3 different components here. So first of all, you see, I think, the core of the paper, as I see it right now, the most interesting part of the results and the most clear results, so to say, as they are in the paper right now, which is the diff and diff analysis on the Paris Agreement. And here we have a focus on the ratings, and as a treatment we look at polluting industries, firms that are particularly intense in emissions and levels, or in terms of their relative emissions to, say, their output. And the main finding here is that firms that are most exposed also see a deterioration in their credit ratings post the Paris Agreement. Okay, so this is the first part and also what I'm going to focus my discussion today on, but then we have two other parts in the paper. So we also have a cross-sectional analysis on the outcomes of both ratings and the distance to default. And there the focus is more on, say, the decision of firms to disclose or not, as well as the decision of firms to follow or set specific targets for their emissions going forward. I think this is also really interesting, and I want to highlight that because Sante and his co-authors have really done a lot of work there to collect data and put together really interesting different data sources, but I'm going to talk about that less in the discussion. Okay, and then third, we also have descriptive analysis in there where we see, or where the authors look at changes in emissions as an outcome as, say, or group by whether firms do have targets for their emissions going forward and whether they are audited. So I think this is also really interesting, but again, not the focus of the discussion. Okay, and just as a slide, again, I think the paper is really packed, so there's a lot of work in there really, and I appreciate that, and I also really, really appreciate the collection of data that is contributed to all of this. What I'm going to pick on today, as my role, is to complain a little bit about what's going on in the paper. So I think the first point, and also what I'm going to focus on, is the question of what can we learn from the pretense that we see in the analysis. And this is less to pick on you or to push back on the result in general. I think there's just something really interesting going on, and I think it might be really valuable for us all to speculate a little bit about what the drivers of those pretense could be. Apart from that, I'm wondering a little bit how good of a marker the Paris Agreement really is for the responses of credit rating agencies, and I'm going to show you a little bit more about what I mean with that. And then third, I think just some points about what could make this paper more digestible, but let's see how far we get given the time constraint today. Okay, so the main point starts with the main result of the paper, or the result that I find most interesting as of now. So what you see here is the classic diff and diff, and so far so good, right? So what we see here is a difference in difference estimator that post-Paris, for the firms that are classified as highly exposed to the policy, we see a decrease in their credit rating. And this is very consistent if we start here. However, where it gets more tricky, and the authors are very transparent about that, so again, not picking on you at all, I think we should just be a little bit more curious about what's going on. So if we dig into this and we look into the trends or the treatment effects for the period before the, actually not the treatment effects, if we look in the effects before the treatment, then you do see that there are actually at times significant effects before the policy. But what I think is really interesting here is the recent input from the literature on the diff and diff revolution. And again, not to just generically bother you all with that, but I think selected papers that are really important in this context are the papers by Jonathan Roth, which are focused on what about pre-trends and why do we have to care about them. And essentially what these papers highlight is that traditionally, what we worried about most for diff and diffs and the tests on parallel trends before the treatment was whether the coefficients before the treatment, as you see them here in the slides, differ significantly from zero. However, one aspect that is really important that goes beyond that is the question, do these coefficients before the treatment also differ from pre-trend? And if we look into these three charts here, even for the ones where we don't see significant effects in terms of a significant difference of the coefficient before the treatment from zero, what we could see there is something that looks like this. So pre-trend, where essentially for the top emitting firms, we see decline in their credit ratings that already starts before the Paris Agreement. And again, why I think this is really important is not to bother Sante, but to think about what that means, because essentially what also Jonathan Roth and his co-authors highlight is if we think about those pre-trends, and if we assume that we probably cannot reject the hypothesis that there was such a negative pre-trend here, this could even mean that we have a positive treatment effect after the treatment, right? So we see that the trend was much stronger before the policy and has not continued as much after. Okay. If we combine that with some more of the results that we see in the paper, so now if we look into the split of the control and the treated groups for, I think this is only for the European firms, right? Yeah. Yeah. So in this chart, also in a way, you see this effect of, you see the ratings coming down pre-Paris already for some of the firms there. I think this is really interesting just because if you survey the literature, you find very similar results in related papers. So for example, if you look in the paper of Ehlers et al., so this is a paper on the pricing of carbon risk and syndicated loans, and instead of credit ratings, what you see in the outcome here is loan rates. You see a very similar pattern, right? So you see that there's a so to say, a continuous increase in the loan rates of firms that are classified as high emitters by very similar standards as in Sante's paper that we've seen today. So just putting together this evidence, so what we see in Sante's paper, but also in other papers, I think it would be really crucial to dig more deeply into these pre-trends and think about what they could mean. So if we, for example, see a strong decrease in credit ratings before the policy already, and we see an increase in loan rates before the policy already, and we see that specifically for European firms, not so much for US firms, I think it would be really important to be creative and think about potential alternative explanations. And I bet Sante has thought about this much more than I have. Maybe some of you have thought about this a lot previously too. One example that I could come up with is if we think about 2011, where we see these effects kicking in, for example, in the IIES paper, is quite an expansion in fracking. So changes in the marginal costs in certain industries. And I think those could also be drivers, for example, of relative advantages of the US, where fracking was relatively not very tightly regulated, and Europe, where I think new technologies were much more limited, and say there could have been a marginal cost benefit on the side of US firms. But again, this is perfectly made up. I just think seeing these significant pre-trends and putting this together with the picture of the, Jonathan Roth et al. Inspired thoughts on pre-trends, I think it would just be really important that we're more critical on this core finding. And of course, it would be really nice to just find that capital markets become really aware of these issues, and that's the end of the story. We don't have to worry about that. I think it would just be really helpful to look into that. And I think, Sante, to get back to your paper also, it could really help you, give you a comparative advantage over as you said, this really exploding literature, right, where it gets really crowded, so to say, on these specific research questions. Okay, but again, this is my main thought. So just given that we see these strong pre-trends in there, I would really say there could be a lot of value in digging into these, and that's probably where I would focus my attention as of now with the paper. All right, so this was comment number 1. I promise the other ones are shorter. So on the next one, if we think about this diff and diff analysis, it's all centered around the Paris Agreement, and the other question that I have is, if we dive into the context of credit risk and credit ratings, is the Paris Agreement really the right point in time to look at, or could there be other interesting markers? And maybe just as food for thought, so what I thought was really notable in this specific context was if we look into credit rating agencies, in 2019, Moody's acquired the first climate data firm, so 427, and incorporated that. And based on what I heard about that, that was really that kickoff of having systematic evaluation of firm risk within the company. And then 2021, they also acquired RMS. So that's a company that was focusing on modeling of risks related to climate. So they really brought in a lot of expertise to try and make all of this real, or make all of this happen, this analysis at the firm level. If we look at the competitors, so S&P, and I think you have both of the companies in your sample, so you have the S&P ratings and the Moody's ratings, then we see that S&P made a similar move. I don't know exactly about the connections through MSCI, but they completed the acquisition of Carbon Delta, so a very similar firm to 427 in 2019 again. So that's when both the big rating agencies started to jump into this and made strategic acquisitions related to that. In contrast, I think it's pretty interesting. So I think Fitch has not bought in any expertise, so they seem to do that in-house. But I wonder if that could be something to explore here, especially if you also have access to market-based data, and if maybe those markers, of course, these events are highly endogenous as well, but I think these markers could be very interesting. So we see 2019, 21, and 19. And then again, I would maybe just sow some doubt about these strong results centered around the Paris Agreement, just knowing that the credit rating agencies started to invest much later into those capacities. Okay, great. And I think we might even still have time for the last comment. So again, really appreciate a lot of the work in the paper. The only thing that I would say as of now is what could help facilitate the read would be a little bit more focus. So sometimes I think there were charts coming in, for example, on physical risk, and there I would just say this is very exciting. I was very interested to see it, but it would be good to just have a little bit more discipline to make it easy for the reader to stay on track in terms of attention. And the other thing that I noticed, and that may also connect to my first comment on the diff and diff and the pre-trends, is sometimes I was wondering where the tension really is between the hypotheses. So I think pretty often if we look at all of these papers, so again, Sante, this is not necessarily just criticism for you, I think this is common to the literature. If we look into the literature between credit risk or credit outcomes and transition, transition risk, we often see this a very straightforward narrative of, yes, investors should do something, look, they're doing something, and that's kind of where it ends. And I think it might be helpful just for the read to get a little bit more tangent into that. And maybe ask more, so to say, the next step questions of, okay, if we look at the magnitudes, what does that really tell us about how far we are away from where we need to be with the assessment? But also then if we look at the pre-trends, I think it would be more helpful to stick out within this literature to be really critical on whether what we find there is actually really proof for investors caring about that or whether there could be strongly confounding trends. Because as far as I see the literature as of now, I think that would be more valuable, so to say, to add in more criticism, so to say, than just one more paper that rides along the null hypothesis of somehow we would expect that people do something, right? Yeah, but then again, I appreciated all the work that I've seen in the paper so far, so I'm really looking forward to seeing future versions of it. Thank you.
So we turn to the Q&A. If you have questions, please raise your hand. Galina has the microphone.
I have a microphone, so I have a question. It's just a data question. So when you gather the emissions by firms, many of those top firms are multinational, vertically integrated firms. So when they do these disclosures, is it like for their overall global total emissions, or is there actually breakdown by the countries of their affiliates and by specific, production stages of their process that might be more polluting than others? The reason I think it matters is, well, partly because I'm going to present in my paper where I think it matters, but, we are concerned about, climate policy shopping, just like the tax rate shopping for multinational companies. So are we already seeing some of the movement of production to countries that have less transition risk, if you will? And so maybe the headquarters location matters less than the affiliate location. So I was wondering if that kind of data is available from the sources you have.
It's a very similar question. I think it's very relevant because firms could manage transition risk just by moving the most polluting production along the global value chain. And I was wondering whether this is the case in your data and whether credit rating agencies react to that and in what direction. Thank you.
Galina, further in the back over there.
Thank you for your presentation. Just one more question regarding the data, the emissions, Scope 1, Scope 2, Scope 3. So I saw that you use in your first regression Scope 1, emissions, and then you add Scope 2, Scope 3. So just more details. Why did you choose the one in the first, and how do you data-related question is related to the emissions?
I wonder to what extent for the credit rating agencies the difference between reporting requirements for US and for Europe differ. And maybe relating to that question with multinationals, if you've seen, I don't know, companies with European and then subsidiary and an American, what would be the difference between that?
Okay, so I have a question as well, and it's related to the last one. I think you have an interesting result between the split of European and US firms. I wonder if you are planning to, or if you explored it a little bit in terms of like what the dividing time is, whether, I know you're exploring the Paris Agreement, but maybe the time series properties of these two sets of firms have differed already even before that. So it's kind of related to some of the questions that came up already, but I thought the split between European and US firms is something that you could explore more in your data set. There is one last question. I think it's the last.
One way that you could explore the parallel trends apparent violation issue is you could do a matching approach. And I think that matching can be very valuable here because it can force you to confront whether or not the units in the control population really are controls for, if you're violating the parallel trend, you're kind of hearing from the data that the control population isn't really a control. And then, so when you look on the suitable matching criteria between this new control population and your treated population, you can maybe really be honest and forthright about what it takes to be a unit that is not treated but otherwise similar. And so that's a hard exercise, but I think would pay dividends, no pun intended here. And then my second comment is, I'm not sure if this matters, but oil. Okay, so we've experienced over the last 3 years or so a lot of volatility in the price of natural gas and oil globally, and for geopolitical and COVID-related reasons. And I'm wondering, that could be a driver of a lot of this. You have a lot of emissions, that means you use a lot of energy, which means you're very vulnerable to price shocks. And basically, if you have a price shock, or either in what you sell or what you buy, then that means that's of course going to create volatility in your earnings, which is going to create volatility in your credit risk. So I don't know whether or not that is just an explanation for what is going on, or if that's a rival channel to what you're doing here. But I'd like to see some more exploration of that issue. Thank you.
Yes. No, first of all, many thanks for the discussion. I think it was really good points that you raised in terms of the pre-trends. That's something that, yes, we have been thinking whether there is some anticipation effect going on, whereby credit rating agency would internalize the policy action taking place in 2015 before, and that could explain some of the pre-trend dynamic that we see. But I think that yes, that's something that definitely we can look more into, and also these other channels that you were mentioning, the channels of marginal cost. That could be something that, given that it's so geographic specific, could be part of the pre-trending. Yes. Then whether the Paris Agreement is a good proxy, it is true that the evolution of the focus on this kind of integrating transition risk into credit risk is more later, and it takes place probably some years after the Paris Agreement. But I think that Moody's, for example, came out with their methodological paper explicitly on how you reflect in the rating process transition risk. Was it already 2014 or something like that? I don't recall the year, but yes, it's something to be precise and see in their publication whether this is the case. Unfortunately, they are not fully transparent to this data about how these factors quantitatively enter the assessment sector by sector, so it's not super straightforward, but something we can do. And then yes, on the structure of the paper, I think that it's something that we can focus about. I mean, the one with physical risk, that was just as a way of explaining why it does not make too much sense of including it as a control in our regressions, but about the magnitude versus the different pre-trends, that one, we can think about. Then I think we had some questions, yes, about whether the greenhouse gases metrics that we use are for the whole production of the firm, or if they are granular for each segment or each subsidiaries of the firm. And they are indeed aggregated, so they are taken for the whole value chain. We're able for scope 3 metrics to distinguish whether they are upstream or downstream. But as I will come back a bit later, scope 3 is also the one that is a bit more tricky emission metric to use for a series of reasons. So probably we still need to think it about from the consolidated perspective when we use these metrics. And then exactly, it was the point, if they move production and then emissions in another country, that will be true, but then when they do the reporting, then it will be, as I said, consolidated, taking into account the production chain throughout. So their exposure to transition risks should still be conditional on the main country where they're incorporated and conducting business. Yes, there was something why we first use scope 1 and then the others. I think that one is related to the fact of how much trust there is in the industry and in the markets for the different scope metrics. So scope 1 are the direct emissions related to the actual production of the service of the input of the firm. Scope 2 is the energy usage, and scope 3 is the whole value chain. So I think that it's already challenging for the firm themselves to accurately report on these 3 scopes. But scope 1 should be, given the methodological limitations that we have nowadays, the one that we trust the most. So that's why we start in the definitive with looking at that one, and then we add the other ones, even though we specify particularly on scope 3 the caveats that come interpreting the significance of that variable given. There are some firms that indeed do report only scope 1, say, scope 2, and scope 3 is missing, but then it's inferred when we don't, when the firm is not reporting it. But then we come to the data quality aspect, like do we trust a scope 3 metric that is not even self-reported, that is actually estimated? It's something, yes, that is a caveat throughout the analysis. Let me see. Yeah, there was something about the difference again between the US and Europe from the whole time series perspective, and I think that's something that we could have a bit more of a look. I think it relates to what Nora was saying with the difference in the trends. And we know how the policy was different. In the EU, we have the emission trading scheme since way back earlier than the Paris Agreement, so really on the forefront. There are the directives coming from the disclosure, the CRD directive coming, I think it's next year. So, yeah, we know that the policy environment is different, but we need to trace it probably throughout. And then finally, on the price shock, I mean, in my understanding, that one would be a bit included in the scope 2 metric, because the scope 2 are the emissions related to your energy use. If you have this price shock and energy becomes more costly, then you could expect that somehow the firm should decrease their consumption of energy, and therefore we will see a decrease also in scope 2 emissions. But yeah, I don't know if that was the channel that you were thinking about.
Well, I have to thank myself for including the paper in the program. Actually, we had another paper on the program. I usually don't put my own papers, but it had to be withdrawn at the late notice. So the best approach was to just put my own. And I have to thank Romanos, before I even see the discussion, for late notice agreeing to discuss the paper that is almost 100 pages long. I really apologize for that. You will see why. Another thing I want to say before I begin my presentation, I'm a director of the CEBRA IFM program. And in addition to organizing sessions at the CEBRA annual meetings, we also try to have more or less annual program meetings. And if you're working for an organization that would be interested in hosting one of our annual meetings and paying for all of it, please get in touch. Usually we come up with a topic of interest that is both of interest to the CEBRA IFM program and the organizing institution. And if you go to cebra.org, programs, IFM, you will see our previous programs that we had on various topics over time, and those are really well attended and I think have been quite successful in the past. Okay, so this paper is co-authored with Grace Gu, who's also at UC Santa Cruz. And we are looking at whether FDI flows respond to climate risks. And previous presenters already discussed a lot of these things, so I don't have to do much of an introduction. We're looking at physical risks, which we measure with extreme weather events. We also look at transition risks, which we measure by policies, but we acknowledge that transition risks can also be coming from technological innovation, and I'll talk about it a little bit at the end. They also could be coming from consumer and investor preferences. So obviously the policy is not fully measuring it, but to the extent that it might be reflecting some consumer preference, maybe it's not a bad proxy. And so the question is, when there are transition shocks, physical shocks, hitting different countries, do FDI flows respond to that? And we want to also know whether what we call emission productivity, which is emissions per unit of output, whether that has an effect on our main question. And we also measure the firm exposure to climate risks by the Sotner et al. Measure that I mentioned before in my question to Daniel. So we start, because we want to a little bit discipline and interpretation of our results, we start with a partial equilibrium model to basically provide intuition for what we should expect. And then we are really looking for some evidence of firms reacting to climate risks. As you will see, this is pretty much a negative result paper, so we have to be exhaustive at showing that we've looked everywhere we could. And it's not just we didn't look hard enough. That's why we don't find much evidence. So I'm going to move a little bit quickly because there is a lot in this paper, and not just in terms of pages. What the innovation on the paper, I think, is really one, is we're looking at multiple levels of aggregation, which allows us to control for an increasingly large set of fixed effects and allow us to see, what might be driving effects, if any. The second thing, you can write pretty much a random model of FDI and find that FDI should increase in response to increase in transition and physical risk. It almost doesn't matter what kind of setup you have, whether it's horizontal, vertical FDI. But what we find is that the model is actually informative because it shows that the effect of how emitting your firm is, or your production process is actually not obvious on how your firm is going to react to the climate risks. And I'm going to show just some graphical predictions from the model to kind of give the intuition for why this might be the case. Empirically, we also find that emission productivity is an important component. Unfortunately, we don't have a good measure of this, right? So we have it at the industry level from World Input-Output Database environmental accounts. And I'm going to show you some of these country industry results where you find pretty clear effects of that emission productivity interaction with physical and transition risk shocks. Once you go to the emissions that you aggregate to country level for other aggregation level analysis we do, there is a very large composition effect there. And that probably also informs us that even within country industry analysis, there is also a large composition effect because the industries in WIOD are pretty broadly defined. There are only 54 industries total. So the work that Sante and co-authors are doing on the firm level emissions is incredibly important in trying to understand how the shocks should be, to Nora's point, like we want to know what should we expect firms to do. And what we learned from our analysis, both the model and the empirical work, is that accounting for firms' emissions is really important. And this is not something we can easily do now because in most countries, emission disclosure is not required. SEC is still working on getting this done. Okay, so I'm trying to go very quickly. So the model is very simple. We are asking a question: when you have a multinational enterprise, how many affiliates it's going to locate in a certain country through mergers and acquisitions. We also do price those mergers and acquisitions, so we have intensive as well as extensive margin predictions from the model. It's a horizontal FDI model. It could be reinterpreted as a vertical FDI if you just put aggregation in the different places. But as I said, most of the predictions would be generated by pretty much any model you write, except what we do is also look at the emission productivity. What we also do in the paper, we have both physical and transition risks, and the model makes some predictions about the interaction between the physical and transition risks. However, I'm not going to talk about this because in the data we found no effects of such interactions, so nothing is significant in that respect. So as I said, the model predicts that when you have a physical risk, the firm would choose to reduce increase in physical risk or increase in the expectation of physical risk. The model is flexible enough to incorporate, say, change in expectations based on, if you have the Bayesian belief update, it could incorporate that. If you expect future physical risk to increase, you would have fewer affiliates in the target country. The same is true of the transition risk, which is we measure as a cost of emissions, cost of producing emissions. And this is the interaction effect I mentioned. The effect of emission productivity by itself, you would have more FDI if the firms in the country are more productive. Emissions is the only input on our model, so that is kind of obvious. There's just more productive firms, so you have more FDI. That's kind of a very reduced form result, so we don't really bet on this, but it's the interactions that are interesting. And here's what I want to show you just to get some intuition. So suppose we have 2 countries. And in one country, the distribution of emission productivity is blue, and in the other country, it's orange. And then we have an increase in a transition risk, say, which is a movement of or a physical risk that moves the threshold of whether the firm would be buying affiliates in that country from gray to green, okay? What you see, and we didn't just make up those distributions. The Pareto distribution is pretty much the productivity distribution that you see in the FDI literature. It's pretty well established empirically. So what you see in this particular situation, the country that has higher emission productivity will lose a larger share of firms when there is such a change in the climate risk, right? So the integral under the curve is larger for the orange one. So we call that better loses scenario. If you're in a better country, you end up losing more. That's not the only possibility. There could be possibility like this. The threshold of investing could be moving from gray line to green line here, in which case if you have high emission productivity, you're not affected at all because that threshold is below your reservation values, and only the ones that our lower emission productivity country would be losing. So that we call better wins. And of course, there could be also that this, the risk is just not material to either, so then there could be no effect, okay? So that turns out to be a non-trivial prediction in the sense that it's very hard to tell empirically where this emission productivity distribution is. Again, we do not have generally firm level emission productivity data, which we would love to have. That's where we are. Okay. On the empirics, we do analysis at a lot of levels. So we have a target country, so just a country level analysis, right? How much FDI is going into a certain country. We're looking on gross inflows, net inflows. We're looking at intensive as well as extensive margins. We also do at the cross-section level as well. We have a cross-section before Paris Accord, cross-section after Paris Accord. We look at this difference from one to another. We also have bilaterally IJ, country pair level, where we can now put country fixed effects. We control for macro things. We interact with post-Paris, et cetera, et cetera. We also do target country industry analysis. So the unit of observation is now country industry. For those data, we do not have a source country, so we can't control for source country policies. But we at least have industry level emission data. And we had to match the industry definitions in FDI data that comes from OECD to emission data that comes from the WIOD. So we did our best, but it's end-to-end matching, so it's not 100% crystal clear. And finally, we do analysis at the firm level, so we're looking at the country, at the firm that's headquartered in country J, what share of the affiliates that firm has in country I, or whether it has affiliates or not at all in country I. So we look at the new affiliates as well as closing the affiliates, as well as intensive margin, which is just measured by a share of affiliates because we don't have total sales or total assets for all the affiliates in the data. And for that, of course, we can control for the country fixed effects, the source country and target country fixed effects, et cetera, et cetera. The details are in the paper. Okay, so really quickly, the disaster physical risk data comes from Emergency Event Database, EMDAT, free, anybody can use it. What it does is record worldwide extreme weather events from 1900 to present. There are thresholds of what is reported as a disaster event. And we focus on 3 types of events: climatological, which is wildfire or drought; meteorological, which is extreme temperatures and storms; or hydrological, which is flood and some other things as well. And we find that most of our results are driven by climatological and hydrological effects. And within that, it's mostly wildfire and flood that produce the results. So meteorological events, like extreme temperatures, tend to have less significant and sometimes opposite signs of climatological and hydrological events. That suggests that having this disaggregation could be quite important in some research. In particular, a lot of papers are focusing on extreme temperatures. And while it is shown in the literature to be a good proxy for physical climate risks in general, in some applications it might not be, because we don't see the markets responding in the same way to those extreme temperatures as others. So interpretation is very important here. We measure the severity of the events by the number of deaths that's also reported in that data that is related to a specific disaster. Transition risk we measure by, in the benchmark that I'm going to show you, IEA has energy policy data. It's not very easy to get, you can't just download the spreadsheet, but you can quite easily scrape the data from their website, which is what we did. Also, OECD has environmental policy stringency index and CO2 tax data. We believe all this are a proxy of how likely the countries to adopt climate mitigation policies going forward, rather than just taking them as actual climate risk at the moment. So it's really kind of a proxy for what firms expect in the future. Finally, we also use NDGAIN Climate Vulnerability Index in some robustness tests. That includes both physical and transition risk to some extent, but we just, we're just putting every data we have in the regressions, because why not? I already mentioned the emission data. I'll skip that. So finally, the climate change exposure from Sotner. This is from scraping the corporate calls transcripts, how much the climate and the risk are measured very frequently. And as Daniel told us, yeah, that tends to trend a lot, but you can see the trend is really kind of picking up after Paris Agreement, which is not surprising. So we would expect firms that are more exposed, or maybe more aware, so maybe they're more exposed, but if they're not talking about it, maybe they don't know they're more exposed. So it's really awareness/exposure interpretation. They should be more reactive to climate risks, and that's what we can test. And because there is a lot of noise in the data, we just have a DIME for higher or lower than medium climate exposure index. We do that not per year, but over the whole sample. So the number of highly exposed or attentive firms is going up over time, consistent with this trend in the index. Okay, FDI data, you can look in the paper, all transitional sources. The firm level comes from Orbis. We just take the biggest firms, and you can look in the paper for details. So the results, we have a lot of regressions. So what I'm going to show you is some summary of the results that we find. And overall, the results show there's little consistent and significant evidence of the impact of climate risks on FDI. Okay, so most of the regressions we run, nothing is significant, signs are all over the place, even though we're trying to control for as many of noise-generating factors as we can. Interestingly, in contrast with some other literature, in particular like syndicated loans literature, we do not find an increase in response to climate risk following the Paris Climate Accord, except in one little exception. And that one little exception is that firms that have a high climate risk exposure, they're more likely to reduce FDI in response to physical climate risks following the Paris Accord. So we see, at the end of our data sample, there is some increase in the attention paid in terms of the, reducing FDI to countries with higher physical risk by firms that pay attention to climate risks. Okay. From the country industry evidence, which is the most reliable in terms of the emission productivity interactions, we find that higher emission productivity actually leads to higher FDI inflows at both intensive and extensive margin. And we find evidence of both effects in whether higher emission productivity makes firms more or less responsive to the climate risks, depending on what are you comparing. So between country groups, we find that FDI is more responsive to climate risks if there is if there is a higher emission productivity, so better loses. But with country industry firm evidence across industries and countries, so not across country groups, we find the evidence of better wins. So the firms with, or the country industries that are more productive or less polluting, they're more resilient to climate risks, okay? So, and this mostly comes from country industry results and some from firm results. You do not see that in the country level analysis, and I think that's because of the composition effects that are really messing up the results once you aggregate this across industries, because depending, your country is doing all high-tech stuff. It's not polluting. Okay, so this is just to show you the count for the regressions we find. So on the intensive margin, the first number is how many significant coefficients are positive. The second number is how many significant coefficients are negative. The third number is the total number of regressions we ran. And you see that for all economies, advanced economies, emerging economies separately. And basically, you see that there is no very clear patterns on the intensive margin. On the extensive margin, we do find that the target countries that experience climatological risks tend to have, especially if the advanced economies tend to have a reduction in FDI along the intensive margin in response to those climate shocks. There are some patterns in terms of interactions with emission productivity that are pretty clear. And here you can see the blue numbers in the top right panel. You can see the difference between climatological and meteorological disasters, for example. The patterns are pretty consistent, going in one direction for one risk and the other direction for another risk, so it's something that could be studied more. Just to kind of understand the relative magnitudes of different risks, what we find is for advanced economies, disaster risks, even though sometimes they're significant and go in the direction we predict, the physical risk is very small in magnitude compared to the effect of emission productivity or transition risk. So the way you see it on this chart is the difference between green-blue plane and the red-yellow plane. So you cannot even see the red-yellow plane for advanced economies. So the shift is very small when you have a disaster as opposed to when you don't have a disaster. And here you see that with higher emission productivity, you have a more response to the climate, to the transition risk, to the climate policies. So the slope of this of the plane is steeper when you have high emission productivity. Okay. You see the opposite in terms of the effect of emission productivity on transition risks for the emerging markets. And you also see for emerging markets, the effect of climate disasters is much larger, which is consistent with the literature. Most emerging markets are located in the area that is more exposed to climate disasters, not Northern Europe or North America. Excuse me. So this is also something that we would expect. Okay. Just really quickly, I know I'm pretty much out of time, but I'm almost out of slides as well. So at the firm level, we also estimate this interaction between how exposed the firm is to climate risks with the response to the physical and transition risk events. And we find that the largest coefficient here, that prior to 2016, you basically see very small coefficients and some of them going in the direction that we would not predict. So the disaster actually increases FDI. Here we find that post-2016, when you have a climatological disaster, the firms that pay more attention to climate risks actually more likely to reduce FDI to advanced economies, also to emerging economies, but this is not statistically significant and substantially smaller. So there is some evidence that maybe there is more attention that the firms are paying to the climate risk, but it's not a very strong evidence. So we do a bunch of robustness tests. 30 seconds. So as I mentioned, emission productivity is very important. There are some other things that we also do, obviously. And so I'm going to stop here. I think I kind of mentioned everything already, so I don't need to summarize it again. Sorry. I can, yeah. It says Hale discussion.
Hello. How do I switch? How do I turn the slides?
There.
Thanks. Okay, so thanks very much, Fernanda and Galina, for the invitation to discuss the paper. So I really enjoyed it, and I learned a lot. And no worries about the late notice. It was an easy paper to read. Everything is not significant, so I'll qualify that later on. So the question that the paper is after is very well defined, in fact, and it's are FDI decisions of multinational enterprises, both at the intensive and the extensive margin, affected by the physical and transition risks at the host country. So the authors, they have two frameworks. They have a theoretical framework, which has a very clear prediction, and the answer is yes. Firms do indeed should, at least in theory, lower their FDI if there are physical and transition risks which increase. And that's the baseline result of the theoretical model. Subject, of course, to a caveat, which is the one that Galina showed, with depending on how the productivity distribution looks like, there may be amplification of this effect or there may be mitigation of this effect. So in certain cases, depending on whether the threshold to purchase affiliates is relative to the lower bound of the distribution, there may be a case where as these risks increase, FDI may also increase further or FDI may lower as a result. So the theory has a very clear prediction. And then they go to the data to test both the first bullet point and the second bullet point. Now, in the empirical analysis, they conduct a number of checks. So Galina showed in the slides. So it's a target country level exercise, bilateral level exercise, country industry, firm. It's a really comprehensive set of exercises. But the answer is that there's not really so much evidence about these effects. They're small and not very robust across specifications. So first of all, let me just say the paper is indeed long, but in fact it reads very well. So it's really impressive how 78 pages of empirical work, 50 pages of tables, can be summarized in just 3 or 4 charts. So Galina just showed one of them, but there are a couple of more which are really illuminating to get a clear understanding of all the different checks that the authors are doing. Now, the theoretical framework is simple, but it's tractable, and it provides relatively nice testable implications, which one can take to the data if that data existed in reality. But, however, it does have very nice predictions, and there's not really necessary to include additional features or bells and whistles to really to achieve some realism there. Now, on top of that, I would say that the data set that the authors provide, that compile, is really impressive, so they put a lot of effort into it, and I expect that it will very usefully serve the profession who is interested in doing work in this field. So I have 3 comments. Some additional, let's say, indirect evidence on why we're not finding, the authors are not finding statistically significant results in the data. Then have a couple of questions about some of the things you're doing, and perhaps some ideas for extensions and further checks. And finally, I have a small comment on the theoretical model and how it could be extended in some dimensions and then to be bridged better with the empirical work that you're undertaking. So So this is results. This is a chart which is published in one of the ECB publications this summer. And it's results from a telephone survey that the ECB conducted in the beginning of the year to around 90 large firms in the euro area, mostly multinational enterprises, asking them about how climate change risks may affect their business operations. So this is a telephone survey. It's not really aimed at obtaining quantitative estimates or predictions about the functions of these firms, but it's more, let's say, to get a qualitative understanding of what are the challenges that certain things that climate change can have on their operations. So I would point, let's say, to the first row, which basically says that only 50% of firms in this sample express some concern that transition risks may affect their overall cost of capital. So I put this chart up here because one of the predictions of the theoretical model is that as transition risks increase, the cost of capital would increase, and then that would lead to a certain number of affiliates to default, and as a result, to limit foreign direct investment through the extensive margin. So perhaps this is, let's say, another form of evidence which corroborates a bit the evidence that you're showing in the paper in an indirect way as to, let's say, saying that firms may not be internalizing the effects of transition on their cost of capital and on investment as well. Now, a second chart from the same survey is this one over here. And again, I pointed to the first row, which asks firms to what extent they agree or disagree with the notion that climate change and different types of risks associated with climate change may cause them to relocate some of their operations. So you can see in the first row, the red part of it, so more than 50% of those firms disagree with this notion. So they do not think they will be relocating some of their operations. So I don't think, we cannot take this as at face value, saying that that may not reduce FDI. However, it is, let's say, it could be used as a proxy or some kind of indirect evidence, again, to corroborate the finding that you find in the empirical work. So now some comments on perhaps missing channels or other, let's say, interpretations of the data or of the different specifications. So understand that in the, let's say, this empirical literature studying FDI, there are some standard determinants which people include as controls. So infrastructure quality, market size, political stability, and so on and so forth. So I know that I have seen that you include a few of them, particularly corporate taxes and other macro variables. I'm wondering why you may not be including all of them if you're not. Second point is, so there's this issue of market power or the size of the firm. So if there is market power, there's a markup. So then as transition risks increase, there's an increase in taxes. The incidence of this tax falls on monopoly rents. So their firms may not be incentivized as much to cut down, on investment or to affect the, acquisition of affiliates. So could it be a story of market power? On the other hand, there could be, let's say, effects operating through the funding model of these different types of firms. So instead of cutting down on acquisition of affiliates, could it be just the case that these firms increase their exposure to debt? They issue different types of debt instruments, so everything is captured in there. So I think it could be important to control for liquidity constraints. And so the ECB has recently undertaken a stress test, has shown some results that different types of banks in the euro area are exposed to different types of climate risks. So it could be that the financial intermediate level, that these effects are operating not at that level of the non-financial firms. And then, okay, let me just skip for interest of time the next 2 points, but it's about, let's say, this profit shifting and greenwashing effect. So where are these affiliates taxed? Are they taxed at the host country, the target country? There are ways, to shift, I guess, profits across jurisdictions. So I have a couple of points. So how does the IEA data look like? So what are the projected policies and how are they counted? So you mentioned that you also include these projected policies. wasn't very clear to me. So another suggestion would be that you could include the EU ETS price as another well-established index of, let's say, physical transition risks. And then as a final bullet point, on the final bullet point on this slide, perhaps, let's say, another way to bridge a bit the analysis of your model and your data could be to split the sample into two subsamples, one with high emissions, one with low emissions at the sectoral, the country level, or countries with high risk versus low risks, and focus on that. That could be, let's say, a mapping with your exercise on the different productivity distributions, let's say, of emissions, potentially. And finally, okay, this is just some thoughts about, let's say, a different mechanism that could be playing out in the theory. This is if we include some dynamics in the model, which may lead to different effects in the short run and different effects in the longer run. And I wonder if, let's say, you can distinguish between different horizons in the data using, let's say, the first difference GMM estimator. So that's it. Thanks very much.
So we have a little bit of time for questions. Anyone? Okay.
So I'm curious, what goes into FDI? So if does it break down sort of what, when, if I have an affiliate, they have a disaster in a country, and you're trying to measure basically some notion of a transaction of some other company that's basically kind of feeding some resources, right, into my affiliate. Do they break down sort of what it is? Because, if I'm sending like a bunch of sandbags, right, into my affiliate, does that get counted as FDI? I mean, if that does, then of course that explains sort of why you don't find anything, right? Because, disaster comes, I send a bunch of sandbags, that gets counted as investment, but it's not really investment. It's just sort of some adaptation or mitigation. So.
Yes, and one more question. I was wondering, so I think you didn't have time to show anything about the modeling, but I was wondering how you think about the learning in this whole context. So I guess there could be a lot going on in terms of transitory shocks and whether they have effects depending on whether or not and how I learn from, say, extreme events and so on and so forth. So I'd love you to tell us more about that.
Galina, you have 1 minute.
Perfect. So let me respond in a backward order. So in the model, we can basically, because everything is driven by expectations, because it's you're making decision now for where you're going to produce next year, any kind of beliefs update could be incorporated in that. And so I tend to think about that as a physical disaster. Suppose you have some kind of prior on the frequency of their arrival. If they arrive more frequently than that, which is what we see in the data, then you update your belief about the future frequency of arrival, and that would be completely, incorporated easily in the model. But yes, I think it's definitely a good question. Harrison, we did think about that. So everything in our data is lagged by 1 year. So we look at the disasters in 2019 and FDI in 2020. So to the extent that you have an immediate adaptation response to FDI, and there is some evidence on that in the literature, that immediately following the disaster, there is a spike. It's also true for trade, for example. There's a spike in FDI because, well, your capital it doesn't have to be sandbags, right? Your machines were destroyed by a hurricane, you need to send new machines. There is a spike, but then the question is, in the year that follows, and we tried multiple lags and things like that, but it doesn't give us any different results. In the years that follows, are you less likely to produce in that country because it's more likely to be hit again? Thank you, Romanos, for a lot of suggestions. Definitely send me a reference to that ECB publication. It would be good for us to cite. A couple of things I want to address. So on the controls, we tried a bunch of things. We ended up not including any variables that limit the sample, because we try to be as comprehensive as we can be, and bottom line is it doesn't matter, and then a lot of regressions, those get swallowed by fixed effects anyway. We do show some dynamics with respect to policies and some of the endogeneity concerns that I didn't have time to talk about. So you don't see much, right? So you don't see much of anything really, which was kind of surprising. For example, you don't see much. You see trend in increasing emission productivity if you just look over time, but it's not driven by emission policies or energy policies. We try to, if you do local projections of this emission productivity on IEA, ETS, CO2 tax, it doesn't matter. It's a tiny, tiny effect, and there was zero significance, almost no matter how you do it. So in terms of IEA policies, I thought we included only the ones that were actually active in a given year. And Fernanda tells me I should shut up. Thank you so much.